Most people believe that superior results come from superior information. They believe the investor who wins is the one who knows more data, more analysis, more access. They spend their careers chasing that informational edge, convinced that if they just knew what was happening inside the company, inside the economy, inside the next Federal Reserve meeting, they would finally be ahead. They are solving the wrong problem entirely. I have spent more than 50 years in this business. I have watched brilliant people lose fortunes and ordinary people build lasting wealth. And the single most consistent observation I have made across all of those decades is this: what separates the wealth builders from everyone else is not what they know, it is how they think. It is the quality of their mental framework, the discipline of their process, and perhaps most critically, what they refuse to do when everyone around them is doing it. Today, I want to share 7 rules, not investment tips, not stock picks, not macro forecasts, because I do not make those, and anyone who tells you they do with any reliability is selling something you do not want to buy. What I want to share instead are 7 principles of thought, 7 ways of engaging with markets, with risk, with uncertainty, that I believe explain more than any other factor why some people build real wealth across a lifetime while others work just as hard and arrive at the same place they started. These rules are uncomfortable. They cut against what financial media tells you. They require you to be wrong sometimes in ways that feel humiliating, but they work. And they work precisely because so few people are willing to follow them. Rule no 1. Stop trying to predict. Start trying to prepare. The financial industry runs on the architecture of prediction. Wall Street produces forecasts the way a bakery produces bread constantly, automatically, and with a confidence that has very little connection to the track record of the person making them. Economists predict GDP. Strategists predict where the S&P 500 will be at year end. Analysts predict when the Federal Reserve will cut rates. And investors, seduced by the authoritative packaging of all this certainty, make decisions on the basis of it. There is a problem. The predictions are almost never right, not in a modest, slightly off way, but fundamentally structurally wrong at precisely the moments when being right would have mattered most. In 2008, virtually no major forecaster predicted a global financial crisis. In early 2020, almost no model foresaw what was about to happen. In the summer of 2021, the consensus view was that inflation was transitory. These were not fringe predictions made by obscure analysts. These were the products of the best funded research departments in the world. I am not saying this to mock those forecasters. I am saying it because I believe the failure is not personal, it is categorical. The future is genuinely unknowable, not just imperfectly known. Complex systems with billions of interacting human decisions do not yield to prediction the way a ball rolling down a ramp yields to physics. Randomness is not just present in markets, it is structural. So what do you do instead? You prepare rather than predict. You ask not what will happen, but what range of things might happen, and how do I position myself to survive the bad outcomes and benefit from the good ones. The investor who survives the longest is not the one who most accurately called the last crisis. It is the one who built portfolios that did not require correct predictions to perform adequately across cycles. There is a meaningful difference between knowing what will happen and being positioned for multiple scenarios. The first is impossible. The second is the entire job. Rule no 2. Second level thinking is the only edge that compound. Here is the most important concept I have ever put on paper, and I want to be precise about it because it is easy to nod along to and very hard to actually execute. First level thinking says, this is a good company, I should buy the stock. Second level thinking says, This is a good company. But does everyone already know it is good? And if they do, is the price already reflecting all the goodness or more than all of it? And if it is already priced for perfection, what happens when even a small imperfection appears? The distinction sounds simple. It is not. First-level thinking is fast, intuitive, and satisfying. It arrives at clear conclusions quickly. Second-level thinking is slow, uncomfortable, and often produces conclusions that feel strange, like selling a company you genuinely admire or buying something that seems terrible on the surface because the price more than compensates for the problems. To be a second-level thinker, you have to ask not just, is this good, but is this better or worse than the market already believes? The market is not competing against your analysis of what is happening. The market has already priced what is happening. It is competing against your ability to identify what is happening relative to expectations. This is why investing is hard, even when you are right about everything that matters. You can be completely correct about a company's fundamentals, its management, its competitive position, and still lose money if the stock was already priced for all of that and more. The information advantage is largely gone. The thinking advantage never will be. Rule no 3. Risk lives where nobody is watching. Most investors think about risk the way a driver thinks about potholes, as visible hazards they can see in the road ahead and steer around. They associate risk with things that look risky. High volatility stocks, distressed debt, emerging markets, speculative sectors. They feel safe with things that look safe, blue chip companies, investment grade bonds, assets with long track records of stability. This instinct is not just wrong. It is dangerous in a very specific and systematic way. Think about a pendulum, a heavy, slow-moving pendulum hanging in a quiet room. When you watch it, you notice that it spends the least amount of time near the center, the point of equilibrium, and the most amount of time near the extremes, the outer edges of its arc. Markets have this same geometry. Prices spend the most time far from fair value and the least time at fair value, which means the assets that look the safest, the ones that have been rising steadily, attracting capital, earning confident consensus endorsement, are frequently the ones that have swung farthest from where they should be. And a pendulum that has swung far to the right will eventually and inevitably swing back. The question is not whether. The question is only when. True risk is not found in the things that look risky. It is found in the things that have been so thoroughly embraced, so universally approved, so systematically bid up that the room for disappointment has become enormous and the room for further appreciation has become thin. The most dangerous trade you can make is the one that feels like the obvious safe choice, because when everyone has already made it, the protection is an illusion. Risk means more things can happen than will happen. And the subset of bad things that can happen is usually the one nobody is talking about. Rule number 4. Asymmetry is everything. Seek it relentlessly. There is a concept I think about every single time I evaluate an investment, and I wish I had articulated it more clearly earlier in my career. The ratio between how much you can make if you are right and how much you can lose if you are wrong. Most people, when they evaluate an opportunity, focus almost entirely on the first number. How much upside is there? How fast could this double? What is the target price? They are optimizing for the right-hand side of the distribution, the good scenario, while treating the left-hand side as an afterthought. Wealth builders do the opposite. They start on the left side. They ask, what happens if I am wrong? What happens if the thesis is correct, but takes 3 years longer than I expect? What happens if the market disagrees with me for longer than I can remain solvent or patient? What is the permanent loss scenario? And how likely is it? And then only then they ask about the upside. Because if the downside is catastrophic and the upside is merely attractive, the bet is not worth making regardless of how good the thesis is. But if the downside is limited and the upside is substantial, then even a modest probability of success creates a positive expected value. That asymmetry, limited loss potential, meaningful gain potential, is the engine of compounding wealth. Warren Buffett once said that the first rule of investing is never lose money, and the second rule is never forget the first rule. This is not a cute aphorism. It is a mathematical fact about compounding. If you lose 50% on an investment, you need a 100% gain to get back to where you started. The asymmetry of losses works against you with brutal persistence. Protecting the capital you have is more important than growing it, because the capital you destroy can never compound again. Rule no. 5. Cycles are not interruptions. They are. The architecture, I want to tell you something that took me a long time to fully understand, even though I had heard versions of it for years. Markets do not have cycles. Markets are cycles. The cycle is not an interruption of some baseline stability. There is no baseline stability. The cycle is the system. Every financial cycle I have witnessed in over 50 years has followed the same emotional sequence. It begins with a general feeling of stability, even prosperity. Capital is available, credit is cheap. Risk premiums are low. Investors feel good. That good feeling attracts more capital. New investors enter. Leverage rises. Prices go up. Rising prices create more confidence. More confidence attracts more capital. The feedback loop accelerates. Then something shifts. It can be almost anything. A small change in sentiment. A piece of news that suddenly reads differently than the same information would have 6 months earlier. And the loop reverses. Credit tightens. Prices fall. Falling prices create fear. Fear creates redemptions. Redemptions force selling. Forced selling creates more falling prices. The same mechanism that inflated the bubble deflates it with equal and opposite energy. The key insight is this. The excesses of the bull market are what create the conditions for the bear market. They are not separate events. They are one continuous process. The seeds of every crisis are planted during the period of confidence that precedes it, and the opportunity of every recovery is created by the despair that defines the bottom, which means the most important question you can ask at any given moment is not, where is the market going? It is, where are we in the cycle? The position you hold in the cycle should inform almost every decision you make. How much risk to take, how much leverage to employ, how urgently to act, and how patient to be. We may not be able to know what will happen next, but we can know roughly where we stand. And that positioning knowledge is worth more than any forecast. Rule number 6. The crowd is not your enemy. Complacency is. I want to be careful here because this rule is frequently misunderstood. Contrarianism for its own sake is not a strategy. The crowd is not always wrong. In fact, the crowd is usually directionally right. Markets do generally go up over time, and most companies with great reputations deserve them. Reflexively opposing consensus is just as mindless as reflexively following it. The real danger is not that the crowd exists. The real danger is when the crowd becomes comfortable, when disagreement disappears, when the bears go quiet, not because they were persuaded, but because they became embarrassed or exhausted, when risk warnings are met with condescension rather than debate, when the people asking questions about valuation are dismissed as missing the point. That is the texture of complacency, and it is the most reliable signal I know that something is stretched. Think of it like a weather system. The most dangerous storms are not the ones that look threatening from the morning. They are the ones that build quietly on a clear day when the barometric pressure has been dropping for hours, when the conditions for a violent event have been assembling gradually, while everyone at the beach is looking at a blue sky and planning for the afternoon. The investor who survives and compounds is the one who monitors the barometric pressure even on clear days, who notices when volatility is low, not because the world has become safer, but because the world has become complacent, who understands that a long period of calm is not a forecast of continued calm, it is an accumulation of unpriced risk. When everyone agrees that there is nothing to worry about, worry more. When everyone agrees the sky is falling, worry less. Not because you are smarter than everyone, but because the price of the asset has already moved to reflect that consensus, and the marginal impact of one more person agreeing with it is approximately zero. Rule number 7. Temperament is the asset nobody talks about. Everything I have told you up to this point, the second level thinking, the cycle awareness, the asymmetric positioning, the resistance to complacency, all of it is useless without the psychological architecture to execute it under pressure. The person who sells at the bottom of a bear market does not sell because they lack information. They sell because they cannot tolerate the feeling. The investor who buys aggressively at exactly the wrong moment does not do so because they misread the data. They do it because the emotional reward of being with the crowd, the comfort of confirmation, the relief of not being the only one, overwhelms their analytical judgment. Intelligence is necessary, but not sufficient. I have watched some of the most analytically gifted people I have ever known self-destruct in markets because they could not hold their nerve when holding their nerve was the most important thing to do. And I have watched people of modest analytical ability build genuine, lasting wealth because they had the psychological stability to think clearly when others were thinking emotionally and to act decisively when others were paralyzed. What does temperament mean, practically? It means the ability to distinguish between permanent loss and temporary pain. A price decline is not a loss until you realize it. A paper loss on a sound investment is not a verdict. It is a weather event, unpleasant, but not structural. The investor with strong temperament can sit with that discomfort without confusing it for evidence that they were wrong. It means the ability to be early without being shaken. Being too early in a contrarian position looks exactly like being wrong. The price continues to move against you. The crowd mocks the thesis. The smart-seeming people on television explain why you are missing something fundamental. And then, usually without announcement, the cycle turns. The price moves. And the investor who held through the ridicule collects what the impatient investor abandoned. It means the ability to do nothing when doing nothing is correct. This is harder than it sounds. Markets reward activity with the illusion of control. Trading feels like working. Sitting on a well-constructed portfolio through volatility feels like passivity. But in my experience, the most value-destructive activity most investors engage in is the unnecessary trading they do to feel productive during uncomfortable periods. The best investment decision you will make in the next 12 months might be the one you decide not to make. Before I close, I want to ask you something directly, not rhetorically, but genuinely, because I think the honest answer tells you something important about your own position. Which of these 7 rules is the one you find hardest to follow, not hardest to understand, hardest to actually do when the moment arrives? Is it the refusal to predict when everyone around you is placing confident bets on the next move? Is it the patience to sit with an early contrarian position while it moves against you? Is it the asymmetric thinking, the willingness to walk away from a trade that has attractive upside because the downside is not bounded well enough? Or is it something more fundamental, the temperament piece, the ability to feel fear and not act on it, to feel greed and not chase it? I ask because I believe self-knowledge is the foundation of the whole architecture. You cannot design a process that protects you from your own weaknesses if you have not first identified what those weaknesses are. And I would genuinely encourage you, not as a rhetorical device, but as a practical exercise, to write that answer down. Put it somewhere you will see it during the next period of market stress, because that is when it will matter most, and that is precisely when you will be least inclined to remember it. Now, let me bring this together. 7 rules, not tips, not forecasts, frameworks for thinking that compound over time. First, prepare for a range of futures rather than predicting a specific one. The future is not knowable with precision, and the investors who require correct predictions to succeed are building on sand. Second, think at the second level. The obvious conclusion is already priced. The edge lives underneath it. Third, recognize that risk hides where comfort lives. The most dangerous investments are the ones that feel the safest, because the crowd has already approved them. Fourth, seek asymmetry obsessively. Limit the downside. Be patient with the upside. Protect compounding by not destroying it. Fifth, position yourself within the cycle, not despite it. Understanding where you stand in the emotional and financial sequence of a cycle is worth more than any price target. Sixth, watch for complacency, not consensus. The crowd is not always wrong, but a comfortable crowd that has stopped asking questions is almost always pricing in too much optimism. Seventh, invest in your temperament as rigorously as your analytical process. The person who can think clearly and act patiently under conditions of uncertainty has an advantage that cannot be screened for, quantified, or copied. Here is the challenge I want to leave you with. Pick one rule, just one, and apply it to the next decision you face. Not all seven. One. The rule that addresses your most persistent tendency in the wrong direction. If you chase performance, apply asymmetry thinking. If you panic at volatility, work on the temperament rule. If you follow consensus because dissent is socially costly, practice second-level thinking in low-stakes conversations first. Sustainable change in investment behavior does not come from wholesale reinvention. It comes from precise, incremental recalibration of the specific habits that are costing you money. The pendulum is always moving. The cycle is always turning. The only variable under your control is the quality of the framework you bring to it and whether you have the discipline to apply that framework when every instinct you have is telling you to do something else. That's all. Thanks for watching.